Good morning, everybody. Today I want to address the effect the pandemic and the budget has had on your personal financial affairs. There's no doubt that last year has been extremely difficult for all of us. And I like to look for history for a bit of inspiration, because I think history can teach us an awful lot and we can learn from what's happened in the past. Winston Churchill said, "If you're going through hell, keep going." The global pandemic has shifted our perspectives, making it much harder to focus on the long term and get too focused on short-term problems and focus on the here and now. This can cause a problem, particularly for investors, because we all know it's very important to focus on long-term planning and not just the here and now. During any crisis, it's not the time to panic, freeze and pull out of markets. I think this is summed up well by Benjamin Graham, who wrote a book called The Intelligent Investor, and he said, "For indeed, the investor's chief problem, and even his worst enemy, is likely to be himself." Investment markets do not like the unexpected, and the shock of the pandemic was not on anyone's radar. Therefore, it was no surprise that we saw markets react very sharply, with sharp falls in the early days of the crisis. This recession was not caused by the familiar failings of corporate, consumer, or financial recklessness. Household saving rates and indeed financial sector balance sheets were well placed prior to the crisis. Essentially, this is a recession which shouldn't have happened. Now, we haven't got time to look at all the markets today, but what I wanted to focus on is what happened and how things have changed since the early days of the pandemic. Represented in this graph here shows that the FTSE All Share, one of the equity markets, fell by 25% in the early days of the crisis. So if you panicked and sold out, you were sitting on a 25% loss. But as is often the case, markets recovered, and over that 12-month period, we actually saw a real return of 4.5% over that 12-month period. Now, for those of you who know me, will know I always talk about the importance of diversification and not putting all your assets in one basket. So the yellow line in this graph represents a mixed portfolio. Now, equally, it was affected during the pandemic as markets fell, and we would expect to see that. But rather than by falling by 25%, it fell at its worst point by 11%. What's more interesting is to see how the portfolio has recovered over that 12-month period, and actually producing a real return of 10.5%. The advantages of diversification are clear. Do not put all your eggs in one basket and spread your investments across a wide portfolio. Isaac Newton is heralded as someone of great intelligence. And back in the 1720s, he bought into the hottest share in the England stock market, the South Seas Company. Now, being a wise individual, he decided to cash out and made 100% profit on his initial holding, making £7,000. And even at that point, he commented that he could calculate the motions of heavenly bodies, but not the madness of the people. He should have heeded his own advice, because what he actually did was buy back into the same holding a number of months later. This is classic FOMO, as the kids would say today, fear of missing out, or in investment terms, herd mentality, chasing a stock that seems to be going up, but why? This graph shows what happened to the South Sea Company share price, and you can see Sir Isaac Newton bought in at the wrong time, sold, and made a massive loss. This is a graph representing Bitcoin. Now, Bitcoin has been in the news a lot recently, and I'm always concerned about the risk of investing in fad investments. Now, there's nothing wrong with speculating. Plenty of people perhaps have made some money for Bitcoin, but you wouldn't want to put your entire wealth into such a fad and risky investment. I've got some concerns. Bearing in mind the concerns we saw from clients who perhaps saw some falls in their portfolios over this year, Bitcoin has fallen by more than 80% on several occasions. We've seen that memory sticks have been lost, passwords forgotten, exchanges hacked, people losing money. There's also a big increase in regulation risk. The FCA have recently moved to ban retail clients investing in certain cryptocurrencies, and we see this as a continuing trend moving forward. So moving on to more traditional markets, we see a few key trends emerging. As Luke touched on earlier, fiscal policy is back. The question is, should we welcome or fear greater government involvement in economics? Higher fiscal spending is inevitable in the current investment cycle, and at the most moment, I would reckon that's cautiously welcomed, but it has to be well executed. Overall, we anticipate some solid economic growth and a strong pickup as pent-up demand starts to filter through the economy, especially as we open up during the early phases, hopefully with a successful vaccine rollout. Now, today, I haven't got time to look at all the asset classes in great detail, so I took a very traditional approach looking at equity markets and bonds, a simple premise of diversification. We anticipate that equity markets continue to offer the potential for good returns, perhaps the UK more than other markets. Looking at some data that we ran with one of our investment partners, this shows you the variability and the potential returns. UK equities have the potential to produce 6.7% annualised returns over a 10-year period. Worldwide equities, excluding the UK, potential for 4.5%. Now, the importance of diversification, if we mix that with bonds to manage the downside risk, bonds in the UK perhaps minimal returns and slightly higher returns with global international bonds. Altogether, that gives us the potential for a well-diversified portfolio produce annualised returns around about the 4%. Now, clearly we can't guarantee this, and we're likely to see some significant speed bumps and variations along the way, but we do believe the outlook is positive. However, we can't ignore the challenges. Again, Luke touched on this earlier on, but increased digitisation is going to be with us. It's going to affect our daily lives, and companies must adapt to be successful moving forward. I think we'll also see a big change in responsible and sustainable investment strategies, largely driven by people expecting companies to do better. But I think it goes deeper than that. A lot will depend on how change is implemented by governments. Will it be the carrot or the stick approach? Will there be subsidies to help invest in better, more sustainable technologies, or will there be penalties for not improving? We can see this coming into effect already, even with some of the big petrochem companies who are trying to reinvent themselves as energy companies, even green energy companies. We can also see it in other industries, such as the motor trade. This is a continuing trend which won't go away. However, we do need to be careful when we are investing and not simply invest in the next fad. Investment markets like a trend, are like a new shiny thing to invest in, and we shouldn't just blindly follow ethical or socially responsible investments. Perhaps better engagement is what we need to do. Surely it's better to engage with the likes of Coca-Cola, encourage them to recycle more, use less water, than invest in smaller startups which may not generate any real returns. And of course, we have to remember we need to keep an eye on the COVID situation and the effectiveness of the vaccine. So turning on to budgetary matters, again, there wasn't a huge amount that changed, but I think that is positive for us. We can see there's a clear direction of travel, and if you look at the history of some of these changes, tax reliefs are only likely to be reduced, allowances are reduced, so we need to take advantage of these whilst they're still available. With regard to pensions, if you can obtain 40 or even 60% income tax relief, I would urge you to take advantage of it now. We're only likely to see this be reduced in the future. Again, looking back at the history, it shows us that the amount you can pay into a pension has been dramatically reduced. Not that long ago, you could pay £255,000 into a pension. That is now reduced to a maximum of £40,000. Higher earners face further restrictions. Now, this is quite complicated to go through here today, but in effect, for each £2 you're above your annual allowance, tapered annual allowance, you lose £1 of your available contribution. I think it's worth revisiting this because I think in the current tax year, because of the pandemic, this has been missed. And if you look at somebody who was earning £210,000 in the 1920 tax year, they would have been restricted to a £10,000 pension contribution. In the current financial year, they can actually put in £40,000. But as I say, I think this has just been lost due to everyone's concern and short-termism with regard to the pandemic. The key headline here is that the tapering used to start at £150,000 and now effectively it starts at £240,000. In the budget, we saw that lifetime allowance was frozen, and again, I think we can see that the continued attack on pensions is likely to continue. Why is this relevant? Well, if you breach your lifetime allowance, the tax penalty is high, 55% if you take anything as a lump sum, and an additional 25% if taken as income tax. I would argue that actually this is a little bit of a stealth tax. So if you look even to when the pension allowance was its highest at 1.8 million, it only affected 610 people, raising 36 million in tax. Now, the latest data we have for the 17-18 year, when the lifetime limit was 1 million, we saw that this affected 3,000 people, raising over 185 million in tax. Now, why is this relevant to you? Well, that position is not likely to improve greatly. So to bring this to life, if you are earning in the order of £80,000 and receiving 10% pension contributions, if you're 10 years away from retirement and your pension fund is currently in the order of £685,000, using some of the realistic expectations we think will happen in investment markets, you're likely to face a lifetime allowance problem. Again, if you're 20 years away from retirement, following that same logic of earning £80,000, net 10% contribution going into your pension, even allowing for inflation, you are likely to have a problem with the lifetime allowance. Just a quick refresher on pension death benefits. There's still a misconception that pensions die with you. They don't. The position does change on age 75, and at death pre-75, there is no income tax, no capital gains tax, no inheritance tax on pensions. Post-75, pensions can still be passed down, but there is income tax if people draw from the pension, but no capital gains tax or inheritance tax. ISAs were frozen in the budget, but the allowances remain at £9,000 for the junior ISAs and £20,000 for ISAs. Again, I made the point of looking at history, and we can actually see that the ISA allowance has been boosted greatly over the years, starting at £6,000 to its current level of £20,000. We often talk about ISA millionaires, and I want to stress the importance of using your allowances. Now, if you had used all your ISA allowances since inception, you would have had a total contribution of £330,000. Again, using our backdated modelling, you would have achieved variable growth, but between a couple, that would have grown to over £530,000. So as a couple, you would have reached that magic ISA millionaire. And this is just a graphical representation of how that would have moved over the years, showing that in good years it's done well, but clearly there has been losses along the way. So this is realistic if you use your allowances. We saw a new initiative announced by Green Bonds, and this is largely for savers. We're aware that there's been a big build-up of savings over the pandemic, and that's only going to increase over the next few months as well. We don't know what rates are available, but this will be launched by NSNI, and the NSI has some work to do to regain some trust after cutting rates earlier this year. So in conclusion, I think we have to look at history, and things do repeat themselves. I can't stress enough, use your allowances. We can see the direction of travel. We need to adapt and move with the times, and most importantly, keep calm and carry on. I'll now pass your course to my colleague Gavin Burchell, who's going to look at property and capital taxes. Thank you.